This is part 1 of chapter 16, focusing on short-term financial planning. When we're talking about short-term financial planning, we're talking about cash flows. So it's very important to understand the sources and uses of cash flow. As we have looked in prior chapters, chapter 2, focusing on operational cash flow and the financial statements, and then also from your prior knowledge in principles of managerial accounting and principles of financial accounting, where we've had the statement of cash flows, we talk about the different ways in which a company will receive cash and disperse cash. And so receiving cash are sources of cash, disbursements, payments are uses of cash. And so we see here in the sources of cash, if we increase our debt, we're borrowing more money. If we increase our equity, meaning we issue new shares, we get more money. If we increase our current liabilities, meaning we delay paying our bills, we keep more money. If we decrease our current assets, the underlying assumption is that we are converting those current assets to cash. And then if we decrease our fixed assets, meaning we sell our fixed assets, we would sell them for cash. As we see here, the uses of cash relate to either increasing our assets or decreasing our liabilities and our equity. One important concept of the many important concepts from this chapter is the operating cycle. And the operating cycle we see here, it's that time required to acquire inventory, sell it, and collect payment. There's a fundamental assumption that we are selling to other businesses, meaning that we are giving them trade credit, which means that we're giving them an invoice and they have a certain number of days to pay. So we see here that the operating cycle is the inventory period plus the accounts receivable period. Going back to prior chapters, when we talk about the number of days in inventory, that's the inventory period. The number of days in receivables, that would be the receivable period. And so adding these together, you could potentially have many weeks, if not months, between the two. So in calculating them, we see here that for the inventory period, we first identify our inventory turnover and then take 365 and divide by that number. So for instance, if our inventory turnover happened to be 12, if we take 365 and divide by 12, we would have 30 point something days. Same thing with our accounts receivable period. We calculate our accounts receivable turnover, and then we take 365 and divide by that number. It's important that we identify those values and identify those numbers so we understand how long it takes for us to acquire inventory and then turn that inventory into cash. One of the offsetting things is the accounts payable period, and so the operating cycle is offset by the cash period. And the cash period just takes into account the time that we pay our bills, which is the inverse for the accounts receivable, which is when our customers pay their bills. And so to calculate the cash cycle, we see here we take the operating cycle, subtracting our accounts receivable period from it, and of course our accounts payable period. And our accounts payable period is just our payables turnover with 365 divided by that number. So we see this graph. This is figure 16.1 from the text, where it shows when inventory is purchased, when it is sold, when cash is collected. And then we see the accounts payable period offsets the cash cycle. And so most would assume that if our accounts receivable period, it's taking our customers 30 days to pay. If we wait 30 days to pay our bills, then we essentially cancel out those, and our cash cycle would become our inventory period. So that's what we're looking at here. So let's look at an example. We see here our inventory period. We have an average inventory of $2.5 million. We have inventory turnover 3.28, and so if we take that that and take 365 divided by that, it comes up with 111 days. Now, just to put that into perspective, 1 month is approximately 30 days. So 3 months would be 90 days. 4 months would be 120 days. So we're 9 days shy of 4 months. Well, 4 months is the entire semester, fall semester or spring semester. There's a lot of business that happens in that time frame. Then we see here our receivable period is added on to that. And so doing those calculations, we discover our receivable period is an additional 57 days. And so it takes us 186 days from the time we acquire merchandise to when we actually collect the cash from that sale. That's almost 6 months. And so that is a tremendous amount of time. There are a lot of bills that have to be paid by the business between those time periods. And so making sure that we have sufficient cash flow is part of the important treasury function of the business. So then what we can do is we can offset the operating cycle with our accounts payable period, which gives us the cash cycle. We see here our average accounts payable is 875,000, and so if we take that cost of goods sold and divide by that amount, we get 9.4, which gives us 39 days. And so one thing that we should be concerned about is that it's taking our customers 57 days to pay, and we're paying at 39. As I mentioned in earlier slides, getting that to the same amount of time would be ideal. So the question becomes is, why does this matter? And part of what the chapter talks about is financial policies, a flexible policy versus a restricted policy. A flexible policy is a conservative policy, meaning that you have a large amount of cash on hand, you have a large amount of inventory on hand, you give trade credit to all of your customers, you have relatively low levels of short-term liabilities, which means that you're paying your bills pretty quickly, which means you have high liquidity. Now, in most business senses, most businesses tend to steer away from the flexible policy and go more with the restrictive policy. Low liquidity, which means we have low cash, which means that we're taking that cash and we're investing it in other things as quickly as possible. Low inventory, basically we're practicing just-in-time inventory. Little to no credit sales. This would be making sure that we're not extending credit to our customers. If you can't pay, we're not going to sell it to you. And then we have high level of liabilities. The restrictive policy in an economic growth scenario makes sense. We can demand our customers to pay early, and we can keep minimal inventory on hand because the supply chain doesn't get disrupted. However, in the case of COVID-19, the flexible policy is what's helping a lot of businesses stay afloat, meaning they have a lot of excess cash so they can pay bills even though they're not collecting cash from their customers. They have a large amount of inventory, which means that they're not stocking out. If you went to the grocery store each week and there's always a stock out of some item that I want, and it's discouraging that you can't buy your products when you feel you need them, which means that you feel like you need to hoard when you can find them. Liberal credit policies, basically you're allowing your customers time to pay, which means that they're still doing business with you, and you're giving them the benefit of the doubt. And then, this is where you might change. You might actually increase your level of short-term liabilities in that scenario, but you don't have to because you have the cash to pay. The flexible policy we see here, no difficulty meeting short-term obligations. However, you have a lower return. If you have more cash on your balance sheet, that's going to return the lowest rate of return, and so that's something to be concerned about. Also, dealing with short-term assets and long-term debt, making sure that all of your debt is long-term is also problematic. In the case of the restrictive policy, you have a higher return in most scenarios. You don't have a lot of storage cost or carry cost. However, you have stock out, which does become a cost, and so that does become an issue. And so this is a policy that we would want in better economic times. So it's really bridging the gap between the two and knowing when a company may need to pivot their policy. So let's talk a little bit about carry cost and shortage costs. So carry cost is the opportunity cost of owning current assets versus long-term assets. And then also the cost of storing inventory. In the case of shortage costs, we see order costs. You have to order more. There's more transferring of cash, and the issue of lost customers, which if I had to pick which evil I wanted to put up with, I would much rather deal with carrying costs than with shortage cost as a business manager. Also, we want to be aware of the type of assets that we have. So what are the difference between permanent current assets and temporary current assets? We see that the permanent, that's the level of current assets regardless seasonality of sales. So it's the average level of inventory, the average level of accounts receivable. Temporary is when we need to make changes. So maybe we have more cash on hand because we're going into a scenario where we need the cash, or vice versa. Maybe we have more inventory because we know we're going to be selling more in the next 2 or 3 months. And so that's what this is focusing on. So this is the end of part 1 of chapter 16, and we'll pick this up in part 2.